Daddy, that show is like the remote for me.
Give it to him, to him.
Give me. I'll give it to you. Daddy, tell her.
Give it to him. Respect your brother. Give me that remote.
Daddy, please, ma.
Use it. What happened? That's suspicious. Don't finish. Yóò mo ti àdìsí yín náà. Mo ti àdìsí yín. Ó dàbí nẹ́tíwọ̀kì yìí ni. Kò ṣáà ń kọ jọ́ìnì látẹ̀kan. Nà mo ti rí gan ń kọ jọ́ìnì lásán ni kò wọlé. Ṣáà ní jọ́ìnì lòún dẹ̀ ń kọ láti bí 2 minutes. Okay.
Hello. Hello, my host.
Hello, Prof.
Hello, can you hear me?
Yes, I can hear you clearly.
Okay, Prof. But you can't see me, right?
No, I can't see you.
Okay, do we have any student on board?
No, no student yet.
Okay. Well, what is wrong now? Why is that I can't view?
I think maybe there's something is wrong with setting because even yesterday, Adeshewa cannot share video.
What
Okay,
of today? What of today?
Today, Prof. Shima we can see Prof. Shima. Let me host. So then you make me co-host. Maybe it's the only host that I can. Let me make you host first. Maybe you can see me. We'll be able
Okay.
to. So I've made you host. So let me see. Maybe I can see you. Can you still see me?
I can see you.
I cannot see you.
Yeah. You are using your system, right?
Yes, I'm using laptop.
So what happened? What is the setting? Do you touch your settings or anything?
How come Prof. Shima was able to use it now?
I can see you.
Yes, Prof. Shima, I was able to see Prof. Shima and I was able to share his notes also.
And you didn't touch your settings at all for video.
No. It's not me. It's not from my side. Even yesterday, Adesua also. We couldn't see Adesua. But was able to, what's it called? Election notes.
Probably that's my own settings here, the system settings. That's actually the issue then. Because I can't see myself. And I swear when I even do the test run now under the settings, I can't see it.
Okay. Prof, can you quickly log into, like they're having issue with logging into professional?
Okay, they're having issue.
Nobody could be able to log in. Maybe since you are waiting for your student, quickly log in and make one of the lecturer and one of the director leave and host.
Okay, I'm logging in now. Oh, I need the system. Prof, okay, don't worry. I will do that. I will do that.
Okay. Hello, Prof.
Yes, but I'm hearing you.
Okay, it's like they've rectified.
Okay.
Lecture has started already.
Okay. But this one that I can't share video, I can't see myself is the issue. I think Candy is around right now.
Is around. You admit him? I can't see him.
Oh, okay. You have given me the host.
Yes, I'll give you the host. I won't be able to see him.
Okay. Let me give back the host then. I will admit him then I'll give back the host.
Let me just make you host.
It's okay. Okay, can I start? Can you hear me now? Mr. Kennedy?
Yeah, I can hear you.
Good evening, sir.
Good evening, sir.
Yes, how was your day? Hope you had a lovely day.
Yes, I do. Are you, sir?
Okay, thank God. Yeah, I do as well. I don't know if it's my settings or what is going on. I won't be able to display myself, but just grant me this privilege for tonight. I'll try as much as possible to resolve it tomorrow. Okay?
Okay. Okay.
Okay. Okay. So today we are going to start a new topic. I believe that we are able to set the foundation of that's for the past two classes right now. So today we will move forward and build on that. So there will be during the class, I might actually unmute your mind and ask you some questions so that we can what? It can be an interactive class. Is that okay by you, sir?
Okay.
Okay,
It's
while we
okay.
wait for the other student, whenever she comes on board, she can easily join us. So, but we can't wait because our time is running out. So, do you have the new material with you?
I have it on my WhatsApp. I've not printed it.
Okay, it's okay. It's
I
okay.
couldn't
Yeah,
print
you can
it.
just open it on your WhatsApp. You can just open it on your WhatsApp, and I will share my screen with you as well. So when I share my screen with you, when we are doing some calculations, you're able to flow because I might not be able to go in and out. At the same time, also you
Okay. I
can
don't
get
even.
a book and
I'm using my phone. I'm not using my laptop now. I'm using my phone, the same phone. So
okay,
it won't be
okay,
your material may not be accessible now.
okay, okay. It's okay. So let's just go on with the class. Like I said, it's going to be a build up on what we did last time. So and I will be
Okay.
asking some question once in a while for us to actually for us to flow. So let me
Okay.
share my screen. Yeah, I believe you can see my screen, right?
I think it's coming up gradually. Yeah, I can see it.
Okay, that's good. So today we'll be looking at the what we call one of the important things to be aware of, and that is the accounting equation and double entry principle. So that's what we'll be talking about. We're talking about the accounting entry, the accounting equation and double entry bookkeeping. Last class, I was aware that you did something about the conceptual framework where you talked about the rules, the concept that underpin the preparation of the financial statement. At the same time, also,
Yes.
you also mentioned the 5 elements of the financial statement, where you talk about the asset, the liability, the equity, the income, and the expenses, right?
Yes.
Okay, that was nice. Now, as you know, that anything in accounting, there's a particular thing that we'll talk about, any in measurements, that anything that is not in monetary terms is not expected to be in our financial statement. Anything that is not in monetary terms is not expected to be in our financial statement. So this give actually a raise that we have two type of activities that we should look out for. Number one, we have what we call the financial transaction, and we have events. That the difference between financial transaction and just ordinary events. Now, financial transaction is an event, but its own event brings about changes in financial position. It is measurable in what? In monetary terms. That is its own. That's financial statement, financial transaction. But the other one, event is an incident or a happening, which may or may not bring any change in the financial proposition. It might actually bring some changes, might not bring some changes. It might actually have some figure attached to it, it might not have some figure attached to it. So those are the example of events. But what you are talking about is that financial transaction that actually change the position of the world, they actually change the position of the financial statement is what we should recognize or what should be accounted for under our financial statement. Now, I'll give an example of that, like illustration 1 that I'll be looking at it. Example of the illustration 1 given to us that, okay, ability to differentiate between financial transaction and event, because actually very, very important for us to know the difference between financial transaction and events. Now, financial transaction. Let's look at illustration 1, Roman figure 1. Mr. Okay, started business with capital. So he brought in capital of 40,000 naira. So that means that there is something that we can attach, that we can measure, that is in measuring what? That is in monetary terms. And that's 40,000 naira. Now, it means that this transaction, it can be regarded as financial transaction because the introduction of the cash into the business have changed the business perspective. It has actually increased the capital, and it has actually what resulted in the increase in capital and also increase in cash. So that transaction is financial transaction. The second one that we have there as well is that we have what we call the pay salary to staff. Now, pay salaries to staff, it means that there's actually what an amount attached to, which is 5,000 naira. That 5,000 naira will lead to an outflow of cash account. Now, if it leads to an outflow of cash account, it means that the financial position of the account have been changed over time due to the transaction. So it can be regarded as financial transaction. The same goes to the third example, which is the purchase of what? Machinery. That was 20,000 naira. It's also a financial transaction. Roman figure 4 also is a financial transaction because we place an order with what? With Sens and Co for goods for what? 5,000. Now 5,000 means that an order, we place an order, but we have not received the order. So it means that we have actually what? Committed ourselves, and based on accurate basis. Accurate basis means that we are expected to record transaction when it what? When it occur, not when cash actually what transpires. So that's why that's also what will be regarded as financial transaction. Open a bank account by depositing 4,000 naira also can be regarded as what? As a financial transaction, which means because when you deposit bank, it's actually what brings about a changes between your bank and your cash book. Now, if we look at the example of Roman figure 6, it says that receive passbook from bank. Now, if you receive passbook from cash, what does that mean? It means that you collected checklists that will be used over time to draw money from the bank. But that does not actually change any account or any balance or any position of your account. So it can not be regarded as a financial statement. It can only be regarded as an event that occur, but it does not have any monetary terms attached to it. So it's what we call a financial, is what we call it event, not financial transaction. Then we now move to the next one. It talks about the appointed sole as what manager on salary of 4,000 naira per month. Now, 4,000 naira per month also means that there will be changes in the financial statement. And once there's changes in financial statement, it means that transaction is financial transaction. Now, the same also go to receive interest from bank of 500 naira. Now, if you look at the last example that we have there, it said that received a price list from what? Lights also, yeah. It said that we receive price list. Now, we receive price list. Receiving of price list does not mean that we are going to purchase any goods from them. What it actually means is that we only request for information and we have obtained such information. So it's not actually a financial transaction, but it's just an event that have occurred. So that also will not have any effect on our financial statement. Another angle for you to understand or how to differentiate if a transaction is financial or just an event is if it falls under the definition of the 5 elements that have been identified in the financial statement. Now, the assets, the liability, the equity, the income, and the expenses all of them actually have a definition. Any transaction that fails to fall in within this 5 element definition, that transaction cannot be what? Cannot be recorded in the financial statement. Now, it's actually very key for us to know, because so that not all events will be recorded, but all events that financial transaction is what that will be recorded in our financial statement. Now, let's look at this. And like I said in the beginning of the class, that accounting equation is actually what is key to the what? To the knowledge of financial accounting. It helps us to prepare, it helps us to understand the double entry principles. It helps us to be able to prepare simple financial statement. It helps us to understand how the effect of give and receive is being taken on accounting for in financial accounting. So financial accounting is fundamental to accounting. It shows that the total assets of a business must always equal the total claims against those assets by creditors and by owners. It means that if a business actually is talking about it have an asset, that asset should be claimable either by the owner of the business or by the creditor. Then that illustration, let us come onto to work. Let us develop or derive a formula. And the formula is what we call asset equals liability plus equity. Don't know your definition of asset. They say assets are resources controlled by an entity as a result of past events. It's probable that there will be inflow of economic benefit to the entity. That's the definition of an asset. It means that you have carried out, you are the owner of the asset, and you are the owner because you have carried out previous transaction, and you are going to enjoy the asset for foreseeable future. Then you can be classified that as an asset. It now says that that asset is what is claimable by two people, either by the owner or by the creditors, which is what the creditors, those that invest into the business. So either by the owner or by the creditor. That's why we say asset equals liabilities. The liabilities there is the creditor's claim plus shareholders' equity. That shareholder is the owner claims on the asset. So if the owner's claim part, the creditor claim part, then the added two together will give us the total asset of the business. So the formula is actually very, very important and key for us to understand. Now let me now break it down again. That asset is classified into two parts. We have what we call the non-current asset and we have what we call the current asset. Now, the non-current asset, these are assets that are fixed in nature. They are assets that have long useful life, like 5 years, 4 years, 3 years. Those are non-current assets. They have long span of life. But current assets are assets that are easily turned to cash within 12 months. Those are not current assets. Those are current assets. Current asset, it means that we can easily convert it to cash within a space of 12 months. Then, if that is the case, then we now have an example of non-current asset, which means that is not easily convertible to cash, and it have long estimated useful life. Example of non-current asset, we have furniture and fittings, we have property, plant and equipment, we have equipment, motor vehicles, and the likes. We have buildings, but under the current asset, example of current asset is we have inventories, we have the trade receivables. Trade receivables is usually known as debtors before. These are the people that are owing the company, that the company is looking forward to collect some cash from them. Another example of current asset is we have prepaid rent. It means that we have paid rent in advance, we have not enjoyed it. Another example also is we have the cash and the cash equivalent. Cash equivalent means that anything that it can easily be converted to cash within the next 3 months. Those are the cash equivalent. So we have that, so those are what makes up the current asset. The addition of the non-current asset and the current asset will give us total assets. Now, liabilities, as the definition says, that is a present obligation as a result of past events, probably the word that the settlement will lead to an outflow of the what of economic resources from the entity that embodies the resources. It means that this settlement, present obligation, present duties, present debts that will result to outflow of economic resources. The economic resources might not actually be cash, it can be services. So when it results to outflow of economical resources later on in the future as a result of past events, probably the person have paid you ahead, you have not rendered the service, or probably they have rendered the service, but you have enjoyed the service, but you have not paid for it. Is what that's an example of liabilities. Now, liabilities also is not divided into two as well. We have the non-current liabilities and they have the current liability. The non-current liabilities are the liabilities that are not settlable within the 12 months, but have a longer span, which means they have a longer span like 1 year and above. But when you talk about the current liability is actually the one that is set to, you can settle it within the space of 12 months. That's current liability. Okay. So now we now have shareholders' equity. Shareholders' equity also can be actually divided into two. We have what? We have the equity and we have the what? Retained earnings. We have the retained profit earnings or retained profit. Now, the retained earnings is what we know as well. It can also be divided into two. We have what we can just subdivide the classified down again to have two aspects, which talk about the revenue and the expenses. It means that the difference between the revenue and the expenses will derive or give us what we call the earnings. So the difference between give us what we call the earnings. So now once we have the earnings, then it means that we can retain part of it or pay part of it out as dividends. Now I'll repeat that again. Shareholders' equity can be divided into two. We have the equity side and we have the retained earnings. We have more. We can be subdivided into. It can be breaking down into more classification. But for the purpose of this class, we're going to break it down into two, which is the equity, the capital, and the retained profit. Now the retained profit comprises of two items, which means the revenue and the expenses. Now, the difference between the revenue and the expenses is what will give us the profit that will be retained in the business. So now what I'm trying to link right now is that I'm trying to link the elements of the financial statement to this equation, to this accounting equation that we have stated. Earlier we said that accounting equation is asset equals liability plus shareholders' equity. And now we have been able to see clearly on the equation the asset and liability, which means we are left with three elements that is not yet seen. But I'm not explaining that even the three elements is visible under the shareholders' equity. Then I went further and I said that shareholder equity can be subdivided into two, which means the equity and the retained profit. Now, the equity is part of what? Is part of the element of the financial statement. Now, the retained earnings can also now be subdivided into two parts. And the two parts will now be revenue and the expenses. The revenue and the expenses have completed the 5 elements of financial statement. Now, the difference between the revenue and the expenses will give us the retained profit. And the addition of the capital or the equity plus the retained profit will give us shareholders' equity. Now, let's move forward because of our time. The accounting equation is actually very useful, like I said, for what? For preparing simple financial statement. It helps us to understand the dual set concept. It means that whenever there's a giver, there's always a receiver. That's what it helps us understand. Now, there's a linkage. When you started with class, I said that we have what? We have a component of financial statement. And I said we have the statement of what? Statement of profit or loss account. We have the statement of financial position. We have the statement of changes in equity. We have statement of cash flow. We have the accounting policy. We have note to the accounts. Now, let us pick two statements out of the component of financial statement. Let's pick the statement of profit or loss and what? Statement of financial position. Now, they are different statements, but they are what? There's something that connects the two together. Now, what connects the two together is what we know as profit. Profit connects the statement of profit or loss account to what? To the statement of financial position. Because the end product of statement of profit or loss account is the profit or loss. Now, without profit or loss will be taken to the statement of financial position under the equity part. If it's profit, it's going to be added to it. But if it's loss, it means it will be what? Subtracted from it. Another one also is drawings. Drawings out of profit also affect what? The statement of financial position. Because it reduces the owner's capital. Drawings means that the owners of the business is taking out of his profit before the end of the year. That's why we're talking about, that's why you call it drawings. So drawings is used to reduce the profit under the equity section, which can be found under the statement of financial position. Now, drawings can be in cash. It can also be in what? It can be in cash. Most of the time, it's actually in cash, but it can also be in inventory. It can also be in assets. For example, now, the owner of the business can withdraw 10,000 naira cash for his personal use. That's drawings. But he can also take part of the inventory, part of the item that is meant for sales for his own personal consumption. That's also drawings. Or he can convert one of the assets of the company to his own personal use. And that also what? That also can be classified or regarded as drawings. Now, let's start on 2 to further explain the accounting equation. Please, you need to understand, you need it to understand the accounting equation. It serves as what? As a basis for you to understand financial statement. Once you get the concept, or once you get how things operate in financial accounting, you will have no issue, and you will not be guessing where to post some financial transaction. Illustration 2. Now, 1 says that commence business with cash of 50,000. Now, it means that it commence business, it's starting business with a cash of 50,000. Now, the business is starting, is introducing something. What is introducing to the business is what we call capital. The amount introduced by the owner of the business into the what? Into the business is regarded to as capital. Then what is it bringing in? It's bringing cash. So it means that we have cash and capital. Now, and the rule says that what? That the giver. Okay, don't let us go there. I think the next one we will explain that better. So don't let us go there. Let us stay on the accounting equation at the moment. Now, commence business with cash of 50,000 naira. The accounting equation says asset equals equity plus liability. So if we commence business with cash, it means that cash received 50,000. We have it there. Now, who is also what? Who is giving the cash? The capital what? 50,000. We have it what? Under our equity. Please, that should be equity. So it means that it will be under what? Our equity. So it means that 50,000 under cash, 50,000 under equity. Now, if we add and liability, we don't have any liability. So that liability is 0. So 50,000 plus liability, which is 0, is going to give us 50,000. Now, asset on the asset side also is what? Is 50,000. So the left-hand side and the right-hand side are the same, which is 50,000, 50,000. It means that our account are balanced. That our account are balanced. That's the meaning. That our account are what? As balanced. Then another one that we have also, let's look at the second transaction. Second transaction, purchased goods for cash, 20,000 naira, and on credit, 30,000 naira. Now, purchase goods for cash, 20,000, and on credit, 30,000. Now, the total purchase made here is 50,000, which is 20,000 and 30,000. And that is actually put under what? The inventory. It increased inventory by what? By 30,000. Now, but cash is giving out cash. The cash that is giving out is 20,000. It means that we what? Our cash will reduce by what? By 20,000. That's why we have what? That's why we have minus 20,000 here. You can see that's why we have minus 20,000. It means that what? We are purchasing the goods by giving out what? 20,000. Then the second one, which is the what? 30,000 is on credit. Then we have what? A liability. It means what? Is the present of the obligation as a result of what? Past event. It means we have collected the what? The item, but we have not paid for it. So we call it what? A trade payable of 30,000 is a liability, because it's due to what? It's subject to repayment in the next future. So that's why we have it here, liability. So now looking at the liability, and this is total what? Total inventory that was received. This is total inventory that was received. Now 50,000 is 50,000 minus 20,000 will give us 30,000. 30,000 plus 50,000 will give us the what? The 80,000, which means the asset region. The asset region is what? Is 80,000. Now the other side, equity capital is what? 50,000. No change about that. Then we have trade payable is what? 30,000. Now if equity is 50,000, liability is what? Is 30,000. 50 plus 30,000 will give us what? 80,000, which is the same thing with the asset region. Can you see the concept, the duality concept I is playing, or the double entry concept I is playing? Because this side must always be equal to this side. Anytime it's not equal to this side, it means that what? We have done a wrong entry. We have done wrong entry. Then let's look at the third one. Sold goods for cash of what? 40,000. Costing, and the goods cost what? 30,000. So we sold goods for what? We sold goods for 40,000, costing 30,000. So we repeat what? We have the same transaction up to, we just copy down from this transaction here. We copy down up to this one. So the third transaction is what we are looking at now. Now, if you sold goods for cash, you receive cash. You receive cash of 40,000. Now, once you receive cash of 40,000, it means that what? Your cash amount have increased. But the cost of the inventory that you have given is what? Is 30,000. So you minus the inventory minus 30,000 to reflect what? The cost of this 30,000. Now that's the asset aspect. But now, look at this way. I put profit here. Remember, I said on this column can be divided into what? Capital and what? And retail profit. Now, this is profit. How do we arrive at this profit? If we make a sales of 40,000 and the cost is what? 30,000, then the profit will now be 40,000 minus 30,000, which is what? 10,000. Now, this 40,000 is the revenue. The 10,000 is the what? Is the expenses, which is the cost. Now, minus it together will give us the 10,000, which are what? Our profits. Now, looking at this, 50,000 here minus 20,000 will give us 30,000. plus 50,000 will give us 8,000 plus 40,000 give us 120. 120 plus minus 30 will now give us 90. So the asset region is 90,000. Now look at the other side. The other side where equity is what? The equity is capital is 50,000. Profits have been added to it now. We have profit of 10,000. So 50,000 plus 10,000 will give us 60,000. The liability remain the same. Now, if the liability remains the same, that means that we have 30,000. 60,000 plus 30,000 will give us what? 90,000. It means that both sides are the same. Then it means that our account has balance. That means that what? We are good to go. Now before we look at the solution for the next one, let's just discuss it and we look at that. Now let's look at it. They say rent paid 500. Now rent paid of 500. What did they use to rent pay? Cash. It means that we need to what? We need to reduce our cash by what? By 500. And the rent that was paid is expenses. And I said that what form of the profit is what? What form the profit is revenue and what? And expenses. Now let's look at the solution. Let's see how it's being done. And if you look at the solution here, we have cash to be what? Minus what? Minus 150 or minus 500. That's as a result of what? Cash have reduced because you have given out cash. It means that your cash have what? Have reduced. So you have to remove the 500 naira of what? Of the rent that we have paid out of your cash. Then you are taking it to what? That rent is an expenses. And that will come under what? The equity part of what? Minus 500. And expense is what? Is an outflow. So with that, we have it as minus 500. Now, if you do your computation, the asset side is 89,500. The other side, which is the equity and liability side, also will be 89,500. Equity is 59,500. Liability is 30,000. Add the two together, you give us what? 89,500. Now, if you look at the last one that we have here, which is the fifth one, if you look at it, it says that bought furniture of 5,000. The furniture worth 5,000, and we bought it on credit, which means that what? There is no outflow of cash. There is no outflow of cash. So we bought what? We bought 5,000. So what do we entry? The entry is furniture, is an asset, it's a non-current asset. It has increased. It enjoy because we don't have furniture before, but now we have furniture. It means what? We added furniture to our asset. It will plus 5,000. But we are yet to pay. Assuming we have paid out of our cash, it will be minus the we now have cash minus 5,000. Since we have not paid for the furniture, then it means that what? We have another liability, which is other payable. Then we now have that 5,000. The difference between the trade payable and other payable is that trade payables are the ones that are directly related to your main activities. Example of trade payables is one we know as creditors before. These are your suppliers. They are the one that supplies you what you need to carry out your activities. While other payables are what? Are the other creditors that you are what? That you own money to. But what? But on a different ground. For example, purchase of assets is what? Is other payables. That's the reason why we separated trade payables and other payables. Now, if you look at the equity side remains the same, which is 59,500. But the liability side have increased by 5,000 because we have what? We have purchased furniture or credit. So it now be 30,000 plus what? Plus 5,000 will give us 35,000. Now, 35,000 plus 59,500 will give us a total sum of 94,500. Why? The other one, the assets area, will give us what? 94,500. So that is what we call what? That is what we call the accounting equation. That's what we call the accounting equation. So before we go on with the class, we like to ask if we have any question on what we have done so far. Oh, hello, Mr. Kennedy, can you hear me?
Hello, I can hear you, sir.
Yes. Do you have any question on what we have done so far before we move forward?
No, it is clear. I'm following it.
Okay, sir. Thank you, sir.
Hello.
Okay, so let's move. Okay,
You're
so
welcome,
let's move
sir.
forward. Okay, so the next one we don't talk about now is double entry bookkeeping. Like I said earlier, we are building on something. We have a target that we want to achieve, and the target is how to prepare financial statement, how to prepare comprehensive financial statement. But before we prepare the comprehensive financial statement, we should be able to work to know what forms the financial statement. Now, after we have identified the accounting equation, then now let's move forward to double entry bookkeeping. Now, double entry bookkeeping, there's something what we call an account. An account. An account simply means summing of the relevant transaction at one place relating to a particular head. It means that transactions that are related or that have similar the same features should be brought together to show, so that we at a glance we'll be able to identify the total income or expenses on such class. Okay, for example, you want to maybe as a business owner, you want to know how much salary that we have paid for a year. So if you want to know that, it means that you need an account that will show you the salary that you have paid on what, maybe on a weekly, monthly basis, to show you that this is the amount that you have paid. So you don't need to start adding, it's going to give you the total amount. That's why we normally call salary account. It means that anything that will be posted under the account must be related to salary. Another one also that we have is what? Another example, we have a lot of it. We have cash account also as well. That's another example. Anything that relates to cash is also what? It will only be posted under the head. The head is the cash account. So every other transaction that will be posted there must be what? Must have the same features before it can be posted under the account. Now, account can be divided into three parts. Account can be divided into three parts. The first one is what we call the personal account. The second one that we have is what we call the ray account. And the third one, we have the nominal account. These are the three types of account that we have. Now, personal account. Personal account is actually account that relate to individuals. It relates to firms, the companies, the corporate societies, the bank, financial institutions. These are what we relate as personal accounts. Now, if you look at it very well, the example I've listed so far, it means that what they are kind of like a living body. They are seen like a living body. That's personal, which means a living thing. So personal account is now subdivided into three parts as well. We have what we call the natural personal account. The natural personal account is the human beings. We human beings, our accounts, the names of what? Of accounts open for each individual is regarded to as natural personal account, but it's still personal account. Example, Kennedy's account. The Kennedy's account can be either receivable for payables or for receivables. It can be Israel account. It can be Ayomi's account. It can be Ayodeji's account, Wale's account. That's an example of what natural personal account, that individual, natural human being, person. Then the second one, you have the artificial personal account. The word artificial personal account help us to know that this one are not what? They are not actually what? Human beings, but they are regarded as what? As woman, as a living, as what? As a living object or living being in the presence of the law. And these are what? Are the people that what? The company can, you can sue the company, and they can also, they are companies, they are firms, they are banks, they are the financial institutions that what? That they are registered. They are registered. So these are the what? These are the example of artificial personal account. They are artificial in nature. That's why we see what we call what? You see the First Bank, you see FCA accounts, you see what we call the Israel and Co account, you see different names, all those company names, they are rated as what? Artificial personal account. Then we now have a representative personal account. This representative personal account is an account that's used to show what? To show the transactions that have happened that's related to what? Individuals. They are recoverable. They are relating to what? To limited expenses and income. Example of them are what? Are the trade payables. They are the trade receivables. They are the prepaid insurance accounts. They are the what? They are the wages outstanding accounts. It means these are what? These are accounts. They are representing people. People are not what? It's not related to what? To pass to a person, but they are what? They are representing them. So that's what? Recoverable. Recoverable. So that they, like I said earlier on, the example of them are what? Wages outstanding, prepaid rent, prepaid insurance, and the likes. Then we now have what? We have real accounts. Real accounts. These are the accounts that are related to assets. They are the accounts that are related to what? To assets. And we have two types. We have the tangible and what? And the intangible. The tangible are the what? Are the assets that we can what? We can see, we can touch, and we can feel. While the intangible assets are the assets that does not have a physical shape, but will add value to the company. Example of the tangible assets: our motor vehicle, our building, our plant, our office, machineries, cash, furniture, and the likes. Well, example of intangible assets, the asset that we cannot see, but is adding what? Is adding value to the business, are what? Goodwill, trademarks, copyright, patent. It means that what? We can't see them, we can't touch them, but we feel their impact on our business. It means that what? We are generating what? Investment. We are generating resources from the what? From the existence of the assets. Example, copyright. Copyright means that what? Nobody else can use this. It means that so far I'm the one who that can use it, then I'm generating what? I'm generating assets from it. Anybody want to use it, they have to come and I will give them franchise. The other one that we have is what? Nominal account. Nominal account, these are the accounts that relate to what? Income and expenses, loss and gain. Any transaction that regards what? Income, expenses, losses, or gains are what? Are classified as nominal accounts. Example, wages account, rent account, interest account, salary account. Remember, I said they are what? Income and expenses. I didn't say they are recoverable. That's what? That's a little bit different about representative personal accounts and nominal account. They are not what? They are not representing them. They are not recoverable. But what we are talking about is their income, expenses, and losses and gain themselves. They are majorly mostly found under the statement of profit or loss accounts. That's what they are, the types of what account that we have. The reason why I'm saying this is what so that you're able to what? Identify the type of accounts and you know how to what? How you will post the transaction at its goal fit. So let us look at illustration 3. You know, we have done with illustration 1. We are done with illustration 2. Now this is illustration 3. It's building up on illustration 1 and 2. Now investment. What type of what account in investment? Investment is an example of what we call the what? The real account, because it's an asset. Investment is an asset. So is what is a real account. Then we have freehold premises. Freehold premises also is an asset as well. So it's classified under what? The real account, which is what? Tangible in nature. The investment is what? It's not, is intangible in nature. And that one we have what? We have accrued interest to what? To right. This accrued interest is personal account, which is under representative personal accounts. Then we have also, this is what? Ayena Agro Industrial Corporation. This is artificial personal accounts. It's artificial personal account because it what? It is seen as a human being in the presence of the law. And that one we have is what? Janata Mechanical Works. This one also is what? Is under artificial personal accounts. Salary account is nominal account. Loose tools account. Loose tools account is actually what? Is an asset. Is what? Is the account that what? That shows the tools that is used. So that's an asset. Then we have what? Purchase account is nominal account because it's an account that shows the expenses. Then we have what we call corporate bank account. This is artificial personal account. We have capital account. Capital account is an example of capital account. That is an example of what? Representative personal account as well, because it's actually what? It shows the amount of what they have, what the owners of the business have actually what put into the business, and is recoverable by the what? By the owner. We have brokerage account. Brokerage account. These are the accounts that, or what is based on what? Artificial representative as well, which means people coming to your companies are what? To register for them. So we have all the rest as well. So you can just fill the rest up. We have realty account. Realty account is an intangible asset. That's a real account. We have sales account. Sales account also is what? Sales account is nominal account. These are the things that you need to know. You just need to know them. But I go through it. If you have any question, please kindly ask me later. So now let's go to rules of double entry. Rules of debit and credit. Please, as an accountant, you must know it. It is a must that anytime they tap you that what is the rule of debit and credit, you should be able to say it straight up without even considering if it's wrong or right, because you should be 100% sure that you are correct. You should be 100% sure that you are correct. Now, let's look at it. Basically, we have what we call what? Debit side and what? And the credit side. Are you with me? So debit side also is the left-hand side, while the credit side is on the right-hand side. Now, whenever there's a word you are receiving, that means that what? You are debit side. You are receiving is what? You debit the receiver and you credit the giver. So is your understanding of how an asset or how an account increase and why another account reduce. So ability to understand when an account increase and when an account reduce will assist you to know the type of asset you are able to whether you are expected to debit it or you are expected to credit it. Now, this is in two. This rule is divided into two. They are the same. Please, they are the same. Don't mix it up. They are the same, but just pick the one that works best for you. The one that works best for you. Now, the first one is that the rule of debit and credit can actually be what? Based on types of accounts, which is what? The personal account, the real account, and what? And the nominal account. Now, for the personal account, we're saying that what? Debit the receiver. Anytime you see the word personal account, it debit the receiver and credit the giver. That's what it's saying. And like I said earlier on, example of personal account is what we have what we call what? The IOMI account, Israel account, and we have FC account. We have, so that what these are the what they are. So they're not saying that anytime you see Israel account, and Israel is receiving debit their account. If Israel is giving, credit that account. That's what they are referring to as personal account there. Now, for real account, then I say that what debit what comes in. Real account is what is intangible and what tangible assets. Now then I say what debit what comes in real account. So if you buy any asset, it means that the asset is added to what? Added to you. What do? You debit it. Now, when you are debiting, what are you doing? You are increasing your asset account. That's what if you are using what types of account. So real account, any asset, anything that comes in for real account, debit it. But anything that goes out, probably to disposals or to replacements or to anything that goes out that is the real account should be what? Credited. They will now have the nominal account. The nominal account what? Debit or expenses. Debit what? Or expenses. Debit or expense. And there should be and there. Because if we debit or expenses, and your losses also, you expect to debit it. So that should be a typo error. Debit or expenses and losses. While the other side say credit or income and gains. Can you see that nominal account? Gains in sense that what? Maybe let's say exchange rates. You gain from your exchange rate. It means that what? You credit your exchange rate because what is gain. Income, example, revenue account. What do? You credit and you are making sales. You always credit your what? Your sales account because it's a nominal account. And the rule says that what? Credit or incomes and debit or expenses. And expenses what is an outflow. That's what debit or expenses and credit or income. That's nominal accounts. So it means that if you understand the types of account very well, you can simply rely on this rule. But if you actually you don't understand the account very well, then you are good with the what? With the you are good with the element of financial statement, the 5 elements of a financial statement, then this one will be what? The second rule will be better applicable to you. So can you see? So we have number 1, we have the type of account. Number 2, we have what? Element of financial statements. Now let's look at element of financial statement. What are they saying about? For example, now under the assets, it's saying that what? Whenever your assets increase, always debit your assets account. Remember, I said that what account is what? Account is actually what? Is a ledger that in which all figures that have the same features are being gathered together. It's like a pool where when you gather things that have the same or similar what features together. That's why I said that what? An increase in an asset. So it can be what? Probably, let's say we have motor vehicle and you purchase motor vehicle. What happened to it? You debit as asset. It means that what? There's an increase in it. But if there's a reduction in the asset, what do? You credit the account. You credit the account. Now let me now show you the difference, the same thing, the similarity between the initial formula and the second table. The first table under real account says that what? Debit what comes in. Now what comes in will increase your asset, isn't it? Now look at the real account is what? It's an asset account. Debit what comes in. What comes in will increase your account. And now the second table is now saying that for asset to an increase in an out. Anytime we have an increase in an asset, always there be the account. Can you see that they are the same? But it's just for you to choose the one that works best for you. Another one that we have an increase. Anytime that an increase in expenses, always debit it. But anytime there's the reduction in expenses, always credit it. Please, you need to know this. You need it. And that also, so let's come to liability. The liability section now say that whenever there's an increase in income, what do? You debit. Whenever there's a reduction in income, you debit it. But whenever there's an increase in income, you credit it. The next one also that was a reduction in capital. You debit a reduction in capital. Then the other way around, you use what? You credit a what? Increase in capital. You what? Credit increase. And that capital is what? Can also what? Equity. Equity also plays that role as well. So we are able to mention, number one, we are able to mention assets. We are able to mention, okay, now, we are able to mention assets. We are able to mention expenses, income, capital, liability. Anytime there's a reduction in liability, you debit it. Anytime there's a reduction, increase in liability, you what? You credit the liability. So the same principles applies to what? To the table A, also applies to table B. Please pick what best for you. You need to know this. It is very, very important. You need to know it. Okay, so meaning and format of what? Of a journal. Now let's look at, if you remember in the first slide, I said accounting process. I actually itemized some accounting process as number one. I said that what? Collection of what? And analysis of what? Information, accounting information. And we started the class with what? With financial transaction. Ability to what? To differentiate between financial transaction and events. That's the word class. The first one talking about classification of what? Collecting and analyzing of what? Financial statement. The second one now says that what? We post into what? Into journal. We post into journal. And that's what we are doing right now. The second one is what? We post into journal. Then from the journal, we now do what? Ledger. So, but before we continue, let's just stop there and go to journal. Now, what is journal saying? Journal is actually what? Historical records of business transaction or events. Like I said, like what? Journal, the word journal comes from the word, the French word journal means day. It means that it's actually a record of what? On a daily transaction on the account that each financial transaction affects. It's actually what? Any transaction that occurs, the first record to update is journal. That's why it's regarded as what? First entry. First entry. The first place to record the transaction is journal. But nowadays, many people don't raise journal again. Many people don't keep journal again. They just use journal to what? To make correction. And the reason is because of the invention in technology, which means the what? The use of Tally, Sage, and the likes. So Tally, Sage, and the likes are actually what? Help us to what? To help us to raise our journal on the net. But many people don't know. But as a chartered accountant and not a scattered accountant, we need to what? We need to know all these little things. These little things is what differentiates us from a bookkeeper. So then what are the journal? Journal have a particular format. The format is what? We have the date, particular, LIFO, debit, and credit. Now, the date actually what? Shows the date that what transaction occurs. The particulars is what? The information that you like to put there. The accounts to be debited, the account to be debited, or to be credited. And at the same time also, explanation, brief explanation. Please, this brief explanation or narration is subject to you. The reason why we normally include brief explanation or narration to it is that when anytime we come back to that transaction, it will give us idea of the transaction that we are looking at. So that's the reason why we normally put the word in narration or brief narration to it. So it means that after 6 months, and I come back to the journal and I look at that transaction, that narration should be able to depict or to explain the transaction that occurred. So there's no particular format to that. It's just based on your own discretion. Now we have what we call the LF is what? The ledger folio column. Under this column, the ledger page number containing the relevant account is entered at the time of posting. The ledger that is affecting is being posted there. That's what the ledger folio column is. So people normally post the serial number of the document. Some people normally post the serial number of the document, while some people normally post the account ledger, the ledger page, the ledger page on it. But serially, recently, right now, people pays what? They post the receipt or the invoice serial number for traceability purpose. They will now have what? The debit. The debit means what? The amount that will be debited. The credit also says what? The amount that will be credited. Now, let's look at one through some advantage of journal. The journal is actually what? One of the advantage is it helps us to what? To eradicate error or to minimize error. It helps us to, we can't eradicate errors. So it helps us to what? To minimize chances of errors. Because if you are doing on a daily basis, as transaction occur, you are raising journal. Transaction occur, you are raising journal. So it helps you what? It helps you to what? To reduce error, because there will not be too much work on you, that you are trying as much as possible to what? To achieve. Probably maybe because you notice that what? You have a backlog to what? To address. You now be what? You'll be increasing your speed, and when you're increasing your speed, you make error. No, but journal, because it's a daily transaction, it's a daily record keeping, it helps us to what? To minimize error. I said that also it helps us to what? It assists us in preparing ledger. Because when you prepare journal, is that information from the journal that you are going to post under your ledger? So it helps you to what? It assists us to what? To prepare our ledger. Also, any transfer from one account to another account is made through journal. Journal is used to what? To transfer amount from one account to another if it does not involve what we call what? Movement of cash. For example, when you make payments now, in experience, for example, now you make payment for rent, and on a month, that rent is for a year. In January, you pay the rent in January, and it's supposed to last from January to December. It's very wrong for you under a crowd basis to account for that rent in the month of January alone. So what you do is that what? You just account for the January month rent alone. The rest, which is 11 months, will be under a what? Rent, we pay rent. So in the month of February, you have to raise journal. And when you raise journal, it means that you are taking part of February, we are taking part of February from the rent prepaid, which is under your current asset. You are taking to your what? Your statement of profit or loss. So journal helps us to what? To help us to move from one figure, help us to move transaction or transfer an amount from one account to another. And that one also what? The entry recorded in journal are self-explanatory because it includes narration. Like I said, explained earlier, the narration helps us to what? To understand the figure better. Another one that we have is what? It can record any such transaction which cannot be what? Entered in any books, in other books or account. Any transaction that cannot be entered the word into any book of account. Probably maybe what you are trying to identify the account to be posted, or you don't know the account to be posted to it yet. You can just raise a journal to it. When you raise a journal, the journal helps you to what? To hold the figure. Out later, when you are able to what? To trace it, you just what? You transfer the figure from the, for example, suspense. Just transfer the figure from that account to the what? To the appropriate ledger that is expected to be found. Then we have that as well. So these are the advantages of all the ledgers. We have the rest as well. Okay, so let's look at illustration 4. Illustration 4. Now, illustration 4 says that post all transactions to journal. That we are required to post all the transactions into journal. So the journal is there for you to go through it, but I'll just explain it one after the other. Then we move on. So the solution is there for you, but don't look at the solution yet. Listen to my explanation. And once you can grab one or two out of it, you are good to go. There's no big thing in the solution. Okay. Now the first one, illustration 4. July 1, Adeyemi introduced 30,000 cash as capital. Adeyemi introduced 30,000 cash as capital. So the first thing that we need to do is that we need to identify the accounts that are involved here. How many accounts are involved? Remember, duality concept or dual concept will play what? It play a major factor under this. It means that two accounts are always involved in any financial transaction. Minimum of two accounts are always involved in any financial transaction. Now, the first one now is that ability to identify the account involved here. Now, introduction of 30,000 cash as capital. So it means that what? We have capital. That's what it was introduced. But in form of what? In form of cash. Capital can be introduced in form of assets. Capital can be introduced in form of inventory. But this time around, it was introduced in form of what? In form of cash. So it means that what? The two accounts that is affected is the cash account and the capital account. Now, it is believed, or the standard says that the first account that must always be written under journal should be what? Should be the account that will be debited. The account that will be debited should be the first account to be recognized or be written under journal. It's not even an example. If you put the credit side, they won't penalize you. But for professionalism, the debit side comes first. Now, like I said, in our double entry principles, like we did earlier, that is going to play out here. That's why I said that we need to understand that very, very well before we go deep into the syllabus. So we have that. So now let's cash and what? Capital. So now we have cash account. Who receive cash account? Cash account, and capital account. So the question is, cash account, is the cash account receiving or giving? And the answer is cash is actually receiving from capital. Okay? If cash is received from capital, are we expected to debit it or credit it? Now, if you look at our rules, cash belongs to what elements? Cash belongs to assets. Cash is an asset. And the rule says that whenever there's an increase in asset, you debit the asset account. So it means that under this cash account, we are going to debit the account with what? 30,000. Then the capital account is one given. And the rule says under equity, it says that what? Whenever there's an increase in what? In capital, what do? You credit the account. So it means that capital account will not work. Will be credited with 30,000. Capital account will be credited with 30,000. Now the narration given there is what? Being capital introduced to the business. Like I said, the narration is subject to your understanding. It's not a fixed. It's not fixed, rather. So July 2nd says that Adeyemi borrows 40,000 naira to purchase a van. Now, Adeyemi borrows what? 40,000 naira. Now, two accounts are involved when Adeyemi borrows. Now, the first one is that Adeyemi borrowed. Number one, loan account. And number two, when he borrowed the money and he collected the money, he paid that money into a particular account. And the account that he paid that money into is what? Is cash account. Another name also that can be given to it also is bank account. Cash account can be used, bank account can be used. It depends on the column that you are using. So we have that. So the first one we have identified, so we are still dealing with the first part. We talk about the loan. So we have the loan account and we have the cash account. So loan account, loan is one given. Loan is given. And we are collecting loan is an obligation to us but we are here to pay. So far is an obligation to us because we have collected money. And that's the past events. And we are going to pay back the loan. It means that loan account is what? Is a liability. And the rule says that whenever there's an increase in liability, what do? We credit the account. Now, cash account is an asset. Cash account is the one receiving the loan amount. So it means that what? the amount under the cash, it means that cash account will increase. And once cash account increase, it means that we expect what to debit the cash account, because it says that asset account, whenever they increase, they should be what? Debited. Are you with me? Thank you, sir. So that's the first one. Now the second leg now is that the money that we collected was now used to purchase van. The money that we collected was now used to purchase van. Now, if you look at this here, it's used to purchase van. So this is the first one that we have done here. The second one now says that van is an asset account. Now, van is an asset account. It means that van is increasing. And once an asset account increases, what do? You debit the account because it's increasing. But the cash account is also an asset account. But this amount is what is giving out the cash. The cash that the loan person paid to the account is now paying to another person to purchase van. So it's giving. And whenever it's giving, it means that our cash balance will reduce. And once our cash balance reduces, the law says that we should credit the cash account. So that's why we have motor vehicle account here to be 40,000. Then the cash account here is also 40,000, which is under the credit column. And the narration is being amount used for purchase of van. See the first narration here. I said being amount borrowed for what? For capital purpose. It can be being amount borrowed for the purchase of motor vehicle. Now, once you have that one here, this one is the second leg here. Then you are done with without the transaction. Then the other transaction says July 3rd. Adeyemi buys inventory for 18,000 on credit. Now, Adeyemi buy on credit. Two accounts are involved as well. The first account involved there is is the purchase account. He buys, he makes purchases. That's the first one. And the second account is if purchase account and assuming he pays in cash. Assuming he pays in cash, it will be in cash account. So far he didn't pay in cash, then it means that is owing the supplier. So if it is owing the supplier, the name that the supplier, they are creditors. And now the creditors' name have now been changed to what we call trade payables. Trade payable. It means that the amount, that trade amount is payable. So now that we have identified the two accounts there, the next thing for us to now identify is which account is receiving, which account is giving. Now, purchase account is receiving. Why the purchase account is receiving? Why the trade payable is giving? Now, the rules now say, after we have identified that, what does the rule say when it comes to nominal accounts? Nominal accounts says that whenever there is an increase in nominal account, what do? Whenever there are expenses, you debit expenses and losses. You debit expenses and losses under under the nominal account. And as well, what do you do about that one? So in the next one is now the trade payables. The trade payables is actually is under representative personnel account, and that one is also you credit the account. You credit the account because it's a recoverable account. You credit the account. It follows the personal account. It's a giver. It's one that is giving. And say always credit the giver. So the rules now say that purchase account should be debited, while trade payable should be should be credited. Then July 5th, Adeyemi pays a supplier 10,000. Now Adeyemi now pays a supplier 10,000. Now, out of the money that is owing 18,000. It now pays 10,000. What does that mean? It means that we need to reduce our trade payables. And I also reduce our cash. Then how do we do that? Normally, as what, at least layman speaking, that's the normal thing we're expected to do. But how do we do it? How do we carry it out in on our financial statement journal? Then we now have what? We have identified the two accounts there. We identified that number one, cash account, number two, trade payable. Which account is receiving? Trade payable is receiving. Which account is giving? Cash is giving. So the receiver will be debited, which is trade payable, by 10,000. Why the giver, which is cash account, will be credited. The cash account is an asset. An asset that reduce will be credited. When an asset reduce, it will be credited. Trade payable is a liability. When a liability reduce, it is debited. You can go back to the former law that the rules of debit and credit that was earlier identified. Then the next one we'll talk about Adeyemi sales inventory. I'm not scrolling down because the answer are the same. I just want you to understand it so that when I'm scrolling down up and down, you not miss it. So that I'm staying on one particular point and explaining it. What I'm explaining right now, the solution is they are the same. Now, July 6th, Adeyemi sells inventory for 12,000 naira each. Now, inventory, Adeyemi makes sales of 12,000 naira. Now, it makes sales of 12,000 naira. Two accounts are involved there. Sales accounts. Now, when the customer pays, they pay into what account? They paid into cash account. Please, not inventory account. It's under cash account. So it means that sales account is actually if I want to use the first table, which is the type of account is nominal account. And nominal account says that I should credit all income. And sales is my income, so I will credit my income. The second transaction is cash. Our cash account is that type of account is the real account as an asset. And it says that whenever the asset given, I should credit my account. So it means that what I'm going to do right now is I'm going to go to my sales account. I'm going to credit my sales account. Then I'm going to come down to my cash account and I'm going to debit it because it's receiving. It has increased. My cash account has increased. So I'm debiting it. So then we move to July 7th. July 7th said that Adeyemi sells inventory for 9,000 on credit. Now it makes sales of 9,000 on credit. Now sales is there. Sales, the credited sales is 9,000. But this time around is on credit. So it's here to receive cash. Then it means that is what we could refer to as trade receivables. It's another form of current assets. Current asset is another form for current asset, which is trade receivables. So it's either whenever you make sales, it's either it comes under trade receivables or it comes under cash. Now, trade receivables, the same treatment will be given to it, which means our sales will be credited, while our trade receivables will be debited. It means that we have increased our trade receivables. We have increased it to show the transaction that have occurred. Then another one that we have is we have July 10th. Adeyemi received 8,000 of the money owed to him, the customer. Now, the customer now pays 8,000 naira. Now, if you look at it now, the customer pays the initial information is present in trade receivables. Trade receivables is the account that owe the amount that is collectible by the organization. Now they have not paid 8,000 of the money that they are expecting to collect. It means that receivables will reduce. And the rule says that whenever an asset reduces, what do? We credit such assets. So we have to credit the trade receivables. Then the other account that is happy that have received the money is the cash account. Cash account is one that is that is joyous right now. That they have received money. Then what do? You now debit it. Can you see? When you credit one account, what do you do to the other account? You debit it. If you debit one account, what do you do to another account? You credit it. So it means that what duality concept, left and right, it has to be balanced. Left, right, left, right. So that's journal. That's what journal talk about. So like we said earlier, journal is what is the first entry of all transaction. It is the place that we record transaction first before it's being posted to ledger. Before being posted to ledger. So you can say this is what we have explained so far. So you can easily go through it. Please have any question, just let me know. So we can go through it. These are journals. These are the things that you need to know. You need to know this. They are very, very, very important. Very, very important. You need to know this. So these are the journals that we have gone through. We have gone through these journals. So I want to know, Mr. Kenny, did you have any question on that?
Just a clarification.
Okay.
Can you hear me, sir?
Yes, I can, sir.
From your explanation, I just want to know, you said for liability accounts.
Yes,
Hello, sir?
Yes, I can hear
Okay,
you,
for
sir.
liability account. Okay, I just want to recap what I understand by the debit and credit. For the liability account, yeah, you said to increase it, we credit it.
Yes, sir.
To reduce it, we debit it. For assets, to increase it, we debit it.
Yes.
To reduce it, we credit it.
Yes, sir.
For expenses.
That's correct. Yes, sir. I'm with you.
For expenses, to increase it, we debit it.
Yes, sir.
To reduce it, we credit it.
Yes, sir.
For equity, to increase it, we credit it.
You credit, yes, sir.
To reduce it, we debit it.
Yes, that's correct. Absolutely correct.
For income, to increase it, we credit it.
Yes.
To reduce
yes,
it, we debit. Is that correct?
Yes. Yes, very correct.
Okay.
Yeah, very correct. Okay, that you are good to go with the second table.
Thank you very much.
Okay, sir. So let's continue the ledger. Let's continue the ledger.
Okay.
Okay. So a ledger. Now we have talked about journal. In journal, when I explained earlier, I said journal is what is the first entry, but after that, it assists us to prepare or to post into a ledger. It assists us to post into ledger. So, and ledger is actually what is another name for ledger, another definition, or what people might try that word as the principal books of account, the prime books. That's the ledger. For example, we talk about every transaction that we have occurred. When we raise the journal, we have cash account appears like 3 to 4 times there, but it's not easy for a businessman to pick up a ledger and try and now start adding up cash, reducing cash. It's not that easy for them. So ledger now helps to bring information that have the same features together, so that it can be easily be identified. Not give complete picture of fundamental elements of bookkeeping. That is the properties, the liabilities, the expenses, the income at a glance. It does not. As a business person, you want to know at a glance what is going on. So that's where the ledger comes in to give you total money at a glance, to work spend over time, to identify the suppliers that are owing, to know the amount they're owing for that is payable, to identify who and who that you are owing, to know the customer that is going to call, that you're going to collect from, to know the profit that you have made, to know the total sales and total purchases that you make. But journal cannot do that. It's only ledger that can give you all these figures. It's only ledger that can give you the figure as it seems fit. And ledger is actually is the principal book of accounts. Like I said, the main feature of ledger is to classify and summarize all the items appearing in journal and other books of what? Original entry. So another the ledger, original book of entry is that what the first place transaction. That's where it comes to. That's what journal. All of them are journal. Or example of them are also other examples apart from journal that this place is referring to as books of original entry, are what we call sales day book, are what we call sales inward, act what we call sales inward, where we have the word art, what again? Sales outward and the rest. These are what they are talking about. Then we now have what we call what? Under appropriate head. Okay? The main functions, let me just say that the main function of the ledger is to classify and summarize all the items appearing in journal and other books of original entry under appropriate head or set of accounts, so that the end of the accounting period, each account contains the complete information of all transactions relating to it. The relationship between journal and ledger, to just brief it, is number one. The journal is a book of ordinary, whereas ledger is the main book of account. Ledger is the main book of account, but the other one is what? Is the original entry, the first place where they enter transaction, like I said earlier. In the in journal business, transactions are recorded as and when they occur. That is that date-wise. Immediately they occur, they are posted. However, posting from journal is done periodically, maybe weekly, fortnight, or per the covenant of word of the business. It means that when you are done with your journal and you have, okay, fine, for you to ease your work up, you can maybe after 2 days, you pick from your journal to your ledger. But this time around, because of what technology, immediately you are raising your journal, automatically your ledger as well is updating. Automatically, they have linked them together. It will update. What people do is that they just input journal. They just say the account to debit, the account to credit. Then automatically ledger will be updated. The journal does disclose the complete position of us. On the other hand, the ledger indicates the position of each account, debit wise or credit wise, as the case may be. That's what credit wise. The liability have what we call the credit balance. So credit wise, liability will have it, debit, while the other one have the assets. They have debit balance. So the record of transaction in the journal is in the form of journal entries, whereas the record in the ledger is in the form of an account. Can you see that? That one the journal is what? Like journal entries, while the ledger is what? In form of account. Now let's look at the format of ledger. The format of ledger is actually what is divided into two parts. You have the left-hand side and the right-hand side, and which is also known as what? The debit side and the credit side, which means the information the same head on the debit side is the same head on the credit side. So we have the dates, we have the particular, we have the journal folio, we have the amount. The date is the date of transaction, the date that financial transaction occur. That is the date. Why the particulars means the account that's involved. The account, the another account, the transaction is where you are that particular. And then after that, we have the journal folio. That's what the information. It can be serial number. It can be also the other information that is being required by the organization. And also we have the amount as well. What I said about the amount of the transaction, the same thing also apply on the credit side. Now, balancing, we need to balance it as well. Balancing of accounts is not alone. We need to balance it. How do we balance? If we look at the left-hand side and we look at the right-hand side, if the left-hand side, which is the debit side, is 20,000, and the right-hand side, which is 10,000. Now let's say it's 21,000. So we have 2,000 here, we have 21,000 here. It means that it has not. They now need to minus it, which is 40,000 minus 21,000, and that will give us 19,000. That 19,000 will now be your balance carried down. that will now use that balance card that will be on the credit side, so that the credit side will be now be 40,000 and the debit side will be 40,000. It means what you have done is what you have closed the account. For the following months now, if you want to start the transaction following month, you are now going to bring the balance of the previous month, which is what 19,000. You now have a balance brought down of what 19,000. That's the balance they are going to use to work with in the following months. Whenever you say balance brought forward, it means that is the balance of previous year. But when it's balance brought down, it means the balance of previous months. It means that the financial year have not closed. So that's the difference between the balance brought down and the balance brought forward. Balance brought forward is for what? Is for a year. While balance brought down is what? Is balance for a monthly basis. So these are the formats that we need. Something is very simple. So illustration 6. Illustration 6 here is all about the same illustration that we use in illustration 5 that we use to post our journals. But now, instead of us posting journals, we're now posting all transactions to ledger accounts. We're now posting to a ledger account. Now, if what we have done earlier on journal is clear for you, then you don't have any issues. There's no concern. You don't have any concern about this one. What we just need for you to work, you just post and input. Just post them and input. Now, let's look at transaction here. The transaction says that July 1, Adeyemi introduced 30,000 naira cash as capital. Now, if you look this capital account now, this capital account, that is the ledger. That's capital ledger. Now, it means that any information that relates to capital will be posted under this capital account. The one that does not relate to capital account will not be posted under this capital account. So we have July 1st. Now, what I've transferred, like I explained earlier, this particulars is the other leg of the transaction. One leg is here. The other leg, this is the first leg. The title here is what? Is one leg. This particulars is what? Is the second leg. It means that if I open my cash account, I must see this leg there as well. That's what I'm talking about. So if I see this leg there, it means that what? You have done the appropriate double entry transaction. Now, I have this July 1, I have my cash, and I have 30,000. So it means that what? This is capital is what? It's an equity. It is increasing. That's why it's what? On the credit side. On the credit side. Now, the second leg for this one is what? Under cash. So I'll go to cash. I'll open cash account. This is my cash account. Under my cash account, I have July 1st. I debited my capital account, isn't it? But now I'm under cash account. I need what? I need to debit it. I will now work on the debit side. I have July 1st. Capital. I see that it's capital that I have here. It's not cash account. It's capital. If you go to capital account, you will see cash of this amount on the other side. So and I have capital account or what? Capital account will be 30,000. It means I've successfully posted my transaction in the world journal. That was it means. I've successfully posted my transaction under the journal into the ledger. Then let's look at the second one. The second one says that what? Adeyemi, July 2nd, Adeyemi borrows 40,000 to purchase a van. So Adeyemi borrows 40,000 to purchase a van. If you look at it here now, I have what? Purchase a van. So the first thing happens is what? A loan and cash. So I have loan account here. Can you see? I have loan account here. Now loan account is what? Is a liability. It means my what? I'm increasing it. So it's all what? It's on my credit side. I have what? July 2. Yeah. I have my cash. It means what? The person that received the what? That benefited from this transaction is what? Is cash account. So now I have what? 40,000. So if I go down to my cash account and I look at it here, I will have loan. Can you say I have my loan? It means that loan. The other account is what? Is loan account. So I come here and I put 40,000. Then that And the second part also is now that money was now used to purchase van. That money was used to what? To purchase van. It means that there must be an outflow under my cash account, and which is credit account. And any outflow, reduction in assets is what? We credit the account. So we now be what? January 2nd, van. Van is the one that is collecting the money that is benefiting for what? Of this cash now. Amount is what? 40,000. So it means that if I go to my what? Motor vehicle account, I must what? I must see that transaction there, which is what? July 2nd, cash, 40,000. Now, this is what the same thing is what I'm going to repeat over time, and what I'm going to now. Now, let's see what I'm doing right now is just a repetition of the journal. But what we are doing is that we are posting into Ledger. And the beauty of it is that at a glance, you'll be able to do it. If you post all these transactions, into the Ledger, then the next thing for you is now to balance it. How do you balance? I've posted all this now. Forget about this for now. So I've posted now. Yeah, I have nothing. I'm expecting to have nothing here because this one is balanced. There's no transaction that's there. But I have this side is 30,000. This is 30,000. This credit side is 30,000. Now, this side is what? I need this side to be the same with this my side. Then I need it to now put 30,000. What is 30,000? Is the balance brought down. Then my total here will now be what? 30,000, 30,000. 30,000. Now, if you look at the also loan account, I have July 31st here. This balance brought this is after the work. Before we have this at all, I'm telling you how you derive at this because you won't see it there. And then it's closing of ledger. Before you derive this, the first thing you have to do is what? You have to look, okay, this is July. Okay, I have 40 here. What do I have here? I have nothing here. There's nothing here. Okay, and I need them to decide to be balanced. Then that I must have 40,000 here as well. So the 40,000 I have here will now be called balance carried down. It means that the balance that is what I will carry down at the end of July is what? Is 40,000. Then after that, I will now have my total is 40, my total is 40, my total is 40. The same thing goes to my motor vehicle. Now, let me show you, all of them are similar. Let me show you one that didn't follow the same pattern here. Trade payables. Look at trade payables now. I have my cash here to be worth 10,000. Like I said, ignore this for now. I have my cash to be what? To be 10,000. I have this side to be what? 18,000. So at the moment, my debit is what? My debit side is 10,000. My credit side is what? 18,000. 10,000 is lower than 80,000. That what? The scale is not balanced. It must balance. So the next thing for you is that this one is bigger. This one is lower. So now be 18,000. So 18,000 minus 10,000, which is what? 8,000. The 8,000 is the difference that we will now balance the account of. We now have balance carry down of what? Of 8,000. This 8,000 is a difference of what? Is the difference between the 18,000 and the 10,000. So you now have 10,000 plus 8,000 is what? 8,000. The following month, the balance that you're going to work with here, following month will now be 8,000. The balance that you're going to work with what is now 8,000. The same thing also, if we look at your cash, let's look at your cash as well. Okay, the same thing. Okay, let me use this one to explain as well. So we have this to what? The sales here is 9,000. The cash here is 8,000. Now, 9,000 and 8,000, they are not the same figure. 9,000 is bigger than 8,000. Then it means that what? There's be a balance of what? 1,000. Now, meaning like this balance is what? Balance border is what? 1,000. It means, what this one means, okay, let me explain this way again. What this means is that I make sales of 9,000. I'm expecting to collect 9,000 from customer. Now, the customer have paid me 8,000. How much am I expecting to collect? 1,000, which is 9,000 minus what? Minus 8,000. And that's what? That is 1,000. It means that my balance, my trade receivables for the next what? For the next month will now be 1,000. That's this 1,000 will now be what? Posted under this column. Balance carry, balance brought down. 1,000. this cash as well. This one as well, the same thing here. We have this figure here. Add all this figure together. Add all this figure together. It will give us figure. It will give us what do it give us? Let me see. That should give us this 30, 70, this 50, 90. So this side is 90. Why this side is 50? So it means that what? This side is what is higher than this side by 40,000. So our balance carried down is 40,000. It means that the cash that we have, the cash, the money value, the cash that we have at the end of July is what? Is 40,000. Even though we started with nothing, but we what? During the month we collected this amount. At the end of it, we have what? We collect. This is the total money that flows into the account. It's on the debit side. This is the total money that left the account, which is what? 50,000. We collected 90,000 and we spent 50,000. The difference is what? Is 40,000. The difference is 40,000. So that's ledger. That's how to close ledger. Because of our time, I would like to call it a day now. So the next one that we have is what we call the trial balance. We shall look at the trial balance in the next class, and we can conclude it. Remember, under the accounting process that I said, the first one is what? Collecting an analysis of what? Transaction, financial transaction. The second step is what? Is posting into journal. The third one is what? Posting into ledger. We have done those 3 steps. Now, the next step is now what? It's now to prepare trial balance. The next one is now to prepare trial balance. Then in the next class, we shall be talking about what trial balance means, how trial balance is being used, and what is the purpose of trial balance. And we will see also just little adjustment for me. But you can read ahead of the class. So that will be very good. So when I'm explaining, you understand better. And also, you can lay your hands on past questions on ledgers and just treat 1 or 2 ledgers. If you have any question, please, anytime, feel free to always chat me up and ask your question, and I will be glad to welcome them. So this will be the end of the class. If you have any question, can you please ask your questions? Mr. Kennedy? Mr. Kennedy? Okay. In the absence of that, I would like to wish you a good night. My host.
Hello, sir.
Yes, I saw.
Well
Done with
done.
it. Yes, sir. Yeah, so done with the class. So we meet at that time.
All right. That's good.
Yeah, thank you for your time, sir.
Yeah, have a nice rest.
You too, sir.
Yeah.
Bye.
Okay. Bye.